And welcome to Monday. It's 1 o'clock and time for the Deal Doctor live stream. Hope you're all doing well today and thanks for joining. First of all, I want to start out by saying thank you to the Carlson family and 5-Star Real Estate for a wonderful party on Friday. I hope that those of you who were able to attend enjoyed yourselves as much as I did. It's nice to be able to put voices that I hear every day on the phone with faces. So I really enjoyed meeting a lot of you in person. Those of you who weren't able to attend, I hope someday we will get that opportunity as well. Oddly enough, things seem to run in my chair. Things seem to run in streaks. Last week I seemed to get a number of calls about owner financing, specifically land contracts. Now, when it comes to owner financing, and I'm just going to use the graph form because I'll just show you where it is. It's actually at the top of the second page. There's page 1, and then on page 2, there's actually an option that you can check for owner financing. Now, most people check land contract right there if they're going to do owner financing. But there's another one over here that I want to talk a little bit about today that is not quite as oftenly used as a land contract. And I'm not sure why, except that back in the day, and I mean back in the day, like way before me even, the way that people sold land was via a land contract. If they were going to buy a vacant piece of land, they put together a deal. And it was largely because banks, credit unions, and so on did not lend money on vacant land. So it was a deal between you and the seller, the buyer and the seller. And so we could establish a price, the buyer and the seller could establish a price for the land, a down payment for the land, and create a contract, a land contract, which stipulated how much we were going to put down, what the interest rate was, what the monthly payment was, and ultimately when we were going to pay that off. What method of amortization was going to be used, and so on. So when we start talking about land contracts, when we talk about owner financing, the first thing that comes to mind is land contracts, because people have heard that phrase, they've heard that term over decades. But that's not the only option. In fact, in many cases, it may not be the best option. For a buyer in a land contract situation, a land contract will not actually pass title. The warranty deed will not pass from the seller to the buyer until that underlying balance is paid off. Now, there may be a 5-year balloon payment, there may be a 2-year balloon payment, there may be a 20-year balloon payment. But ultimately, that warranty deed that is held by the land contract holder, the lien holder, is not passed to the buyer until that underlying balance is paid. Now, that's not, and it was done to protect the land contract holder. It was easier for a land contract holder to get his parcel back, his land back in a land sale, if he held the warranty deed, possession being 9/10 of the law. So if the land contract, the lien holder, was holding the warranty deed, then the buyer had a much harder time getting that property, even though he might have paid 75% of the property's equity off over time, and then suddenly wasn't able to pay it any longer. But there's another option, and that's purchase money mortgage. One of the downfalls of doing a land contract is that if we find it very often between parents and children, where mom and dad are going to buy a house on a land contract, and they are going to sell it to their child under a land contract, or they pay cash and then they sell it to their child under a land contract. Well, that means that there are actually two sales that occur. There's a sale which occurs that's a land contract sale and closes at a title company, just like everything else. But there's also the sale from the parents buying it from whoever the previous seller was. So you have two different closings, and then you have a third closing. The third closing is when the child pays off the underlying balance and that warranty deed transfers from parent to child. So one of the other options is the purchase money mortgage. A purchase money mortgage acts just like a land contract in the sense that you can establish the down payment, you can establish the terms of the contract, the interest rate, the down payment, the amortization rate, and a balloon payment or payoff date, except the warranty deed passes from the land contract holder, the lien holder. It passes to the buyer just as it does as if you went to a bank or a credit union and got a mortgage on the property. The advantage to the buyer is that they now are in fact the owners of the property. They have a lien on the property, just as if you went down to LMCU and got a loan on it. But it gives them the option to make improvements on the property. The land contract does too, but very often buyers will feel reluctant to make improvements on a property that they don't hold the warranty deed for. So the purchase money mortgage does a couple of things. Number one, it cuts out essentially two transactions, two other closings. There's only the one closing, which goes from the seller of the property directly to the buyer of the property. In my case, in the example I'm giving, the child, it goes directly from the seller to the child, with the parent bringing a check to closing for the amount that the buyer is paying or is owing on the property. So they act just like the parent, the National Bank of Mom and Dad, act just like a mortgage company. So it's really it's kind of a twist on owner financing. Rather than doing a land contract, which is multiple steps, a purchase money mortgage acts the same way, except the warranty deed actually passes to the buyer, just as it would if you had a mortgage from a bank. There's several things about owner financing which I want to address. One is, over the years, land contracts and, to that extent, purchase money mortgages have gotten a bad rap, in my opinion. The fear is that the buyer is going to cause damage to the property and basically not be able to pay the monthly payment and eventually give it back to the lien holder. That's true of any mortgage. That's true if you get a loan, a 3% down, 3.5% down loan from LMCU or someplace else, or Northern Mortgage. So I guess the point I'm making is that there doesn't need to be a high level of risk in order to sell on a land contract or on a purchase money mortgage. You can still do a credit report and make sure that the buyer that you're selling to has good credit. They may be in, there's a number of situations that they may be in. Maybe recently changed jobs or changed careers, relocated to the market, had a bankruptcy, but have resolved all of their issues, going through a divorce. There are a lot of situations where a land contract or owner financing is a viable option and a good option for both parties. As you can figure out, if you take $150,000 and you put it in a bank in a CD, you're not going to get a real high interest rate right now. Whereas if you put it into the investment of the home and said, okay, I'm going to take a monthly payment for this, just 5% per year, I'm just going to round the numbers off to a $100,000 mortgage. That's $5,000 a year that homeowner could be collecting in monthly rent. Monthly income rather than rent. The option, the one option is to, if you own a house free and clear, you can rent it, you can sell it, or you can sell it under owner financing. Under owner financing, the advantage is that the buyer has investment in the property. They've got skin in the game, so they want to take care of this property. They not only have a financial investment, but they also have an emotional investment. This is their home now. It's not someplace they're renting. They want to improve. They want to build equity because they know if they repaint, redecorate, fix it up, that's going to raise the value of their property. And ultimately, when they get to sell, they'll be the ones who will benefit from that sweat equity. Whereas in a rental situation, generally, there's only one way but down. In rare cases, I would say a minority of cases, their rental situations, the property ends up in worse shape than it was when they started out. Quite the opposite is true when it comes to owner financing. Again, buyers who are buying under owner financing are going to want to fix up the property, build their equity. Maybe they raise the value of the property by $20,000 or $30,000 or $40,000, and then when it's their turn to sell and move on, they have the $40,000 additional nest egg that they can go down and put on another piece of property. There are limitations to land contract and purchase money mortgages, however. One of them is that you can't sell it if there is an underlying mortgage which has a due on sale clause. If there is language in the seller's mortgage that says that this note will become due upon a subsequent sale of the property to anyone under any conditions, that they have to pay off that that existing mortgage. So that's a big deal breaker right there. If your seller knows, or if you run a title search and find out that there is a underlying mortgage with a due on sale clause, then the likelihood is between slim and none that you're going to be able to sell it on a land contract. The other thing I would caution is that when you are going through the process of considering or weighing a land contract or purchase money mortgage offer, that you don't give up good credit simply to sell on land contract or purchase money mortgage. Don't give up good credit for owner financing. You will get a lot of calls from people who have almost nothing down and have very bad credit, who want to buy on a land contract because there are some what I'll call predatory sellers out there who will sell on a land contract with very little down, but what they will do is they will jack up the interest rates very high to the point where the buyer really has no real expectation or hope of building any equity in the property. So in order to protect your seller, you have to be pretty careful and make sure that you're giving them, offering them a buyer who has good credit. Now, what's good credit? Well, it depends. That's really something for the seller to answer, and obviously a credit report helps. But depending on the sophistication of the seller, in terms of have they sold on a land contract or purchase money mortgage before, are they aware of the risks? Are they willing to accept more risk than maybe somebody who doesn't have a big nest egg that they can fall back on if something happens that doesn't turn out so well, that they get to take the property back? So you have to kind of weigh the buyer and make sure that what they're bringing to the table is in fact a good offer, both from the standpoint of money, income to the seller, but also from a level of safety for the seller, so that they're not going to be needing to take the property back at some point. The other thing for the seller is they're no longer a landlord. In both of these cases, a purchase money mortgage or a land contract, the buyer becomes responsible for when the toilet breaks at 3 o'clock in the morning or the furnace goes out at 2 o'clock in the morning. The lien holder, any more than a bank, is not the one who's going to get the phone call at 2 or 3 in the morning to say, come fix my rental unit because you're the owner of the property. No, the buyer is the owner of the property and therefore responsible for repairs, just as if they had gotten a mortgage down at Northern Mortgage. So I think that's really important to for us as agents to know when we have a buyer who might be a good fit in terms of their credit, in terms of their down payment, and income, that they would be a good, solid buyer, but we don't have the ability to get them a mortgage, and we have a house for them that is paid off and the seller is able to sell it on a land contract or purchase money mortgage. One of the first things you have to figure out, and again, I'm going to do $100,000 simply for round numbers because it's easier. The down payment, the amount of money, cash to close, that a buyer is required to bring to closing for either a land contract or a purchase money mortgage is going to depend on how much cash they have, but also how much the closing costs are going to be and how much the seller is going to require some skin in the game, some level of investment to give that seller an adequate level of security. So let's pretend the sales price is $100,000. The minimum I would suggest, the minimum I would even consider, is 10% or $10,000. The reason is this. First of all, there's going to be a commission. I'm going to just throw it out there that maybe it's 6%. And then there's going to be closing costs. If you have both sides of the transaction, for example, there's going to be there's a $295 on each side, and there's a closing costs of closing at the title company, recording a memorandum of land contract, or recording the mortgage with the county. So there are costs involved, and title work, of course. So there are costs involved, just as there is with doing a mortgage at a regular mortgage company or credit union. So, between commission and those credit and those closing costs, that could amount to about 8% of the sales price. That leaves about 2%, or about $2,000 in my example of a $100,000 house. That leaves about 2%, $2,000 as safety money, is essentially what boils down to a security deposit for the seller. Now, maybe the seller isn't willing to sell his or her home under a land contract or purchase money mortgage with only a $2,000 security deposit. Essentially, it's not a security deposit. It's actually money they paid down on the house. But for purposes of illustration, I'm calling it that. Maybe they say, you know what? I would do this if it was $20,000 down, or I'd do this if it were $15,000 down. If I have to take that property back into my possession, if I have to foreclose on it, or if I have to give them a notice of quit under a land contract, I want to be able to get that property back. And if I have to put $2,000 or $5,000 or $10,000 into it, I want to have that money in the bank to be able to do it. So what a seller is going to require and what a buyer is going to be able to provide in terms of a down payment, that's a matter of negotiation. But what I have seen in some cases is agents have written, let's say $2,000, $3,000, $4,000, $5,000 down in their land contract as a down payment. Unfortunately, that's not even going to cover their commission if they're getting a normal commission for both sides. And again, you can charge whatever commission you want, but again, there's going to be a $295 for each side, whether another agent company is involved or not. One of the first things that I do when I'm starting to think about whether I'm going to do a land contract or not is I run an amortization schedule, because I want to know that if, again, let's do the $100,000, and let's say that I'm going to charge 6% interest as a seller. The seller says, yeah, I'll do it. I'll do it for 6% per year. Well, that's not bad money. That's about $6,000 a year. But I run an amortization schedule to determine where in that amount of money on a 30-year amortization, how much is my buyer going to have to pay in order to be paying down the mortgage and not allowing the mortgage to get into negative amortization where it starts actually adding up to owe more. So always do an amortization schedule. There's one on Flex. There's one on most of the MLSs. You can find them even if you just Google amortization schedule. You can pull those up. You want to be able to make sure that your buyer is accruing equity as they pay their monthly payments, not losing equity. And again, any questions, holler at me. The other big issue that we run into is who's going to pay for the fire and hazard insurance under either case, under land contract or under a purchase money mortgage. And it's a negotiable item. But whatever you negotiate, make sure that you, number one, you get it in writing, and make sure that it includes the requirement that whoever is paying it must verify to the other party that it has in fact been paid. The property taxes as well as the fire and hazard insurance. Here's what can happen if you don't. The land contract or purchase money mortgage says that the buyer is going to be responsible for paying the summer and winter taxes. Well, the summer and winter taxes come by and they pass and they do it again another year. Now they're 2 years behind, and no one has told the land contract holder or the purchase money mortgage holder. And suddenly now this thing is going up for a tax sale and the lien holder doesn't know anything about it. The way I find it is more, it is safer for the lien holder is if the lien holder collects the taxes and pays the fire and hazard insurance just as a mortgage company would in a typical mortgage, PITI, principal, interest, taxes, and insurance, that you calculate their monthly payment based on the principal and interest, which is going to amortize their loan. It's going to help the buyer build equity, and then on top of that, a monthly allowance, a monthly amount for 1/12 of the property taxes, as well as 1/12 of the fire and hazard insurance. Now, the lien holder is responsible for paying off, keeping fire and hazard insurance and keeping the property taxes in place. But how does the buyer know that? Well, the buyer has a right as a land contract purchaser or as a purchase money mortgagor. They have a right to know whether or not those taxes have been paid. Now, obviously, they can check with the township or county as it regards the payment of the taxes, but they also need to know that the fire and hazard insurance is always in place. So they can actually be named on both of those to be informed by either the municipality and or the insurance company in the event there is a lapse in coverage or the property taxes didn't get paid. So there's a lot. It's intricate to put one of these together, but really not very difficult once you've done a few of them. I've done a bunch of them, and I find that they're pretty handy. They close pretty quick too. But if you run into where they say, hey, you know what? I'm a seller. I own my property outright. I'd be willing to sell it on a land contract or a purchase money mortgage because I want to benefit from getting 5 or 6% interest on the value of my land or dwelling rather than put it in the bank and get whatever they'll pay me on a CD. So that's a pretty complex half hour we just spent. And if you have questions on that, if you run into that situation, let me assure you that I can help you. I can help walk you through the process. Once you get the information stipulated on the purchase agreement as far as what the interest rate is and what the down payment and the balance and the payoff is, that once you get all of that information in place, the title company will pull the land contract memorandum from that information. Same thing with a purchase money mortgage, and then they will record that at the closing. So it's really pretty simple once you get past the hurdle of putting the information into the contract. So, wow, that leaves me pretty close to 1:30. And I don't have anything more to say other than I wish you all Merry Christmas, Happy Holidays, and I won't be here next week. See you probably after the holidays. All right. Bye now.